Hello, here we are again. We are starting on the chapter 5 of the paper 5 of the investment link policy, and this is Rianita. And we will try to record the tutorial for all of you on the chapter 5, the investment link long-term business. So, chapter 5. Right, here we are. Risks of investment. So in any investment, we have a present value with a future value, and it's just involved in some terms of sacrifice of the present value for the future value and involve some risks for it. And what is risk? Risk is something that will change, make the terminal value, the future value uncertain. And that uncertainty is called the risk of that investment because the amount of investment may increase or decrease during this period, during this investment period. Uncertainty is called the risk level. Larger is uncertainty, meaning the larger the ups and downs of the investment, the larger is the risk. And the types of risk. There are many types of risks involved in investment. One is called the market risk, which is supply and demand risk, which is affected by a number of factors. The company risk, the company issue the bonds, the stocks, have the risk itself. See, because it may bankrupt, it may have severe market situations that may affect the investor's value of this company. And there is economic downturn risk, unemployment rate, inflation rate, fiscal policy of the government, monetary policy of the government, international exchange, trade wars, for example. These are the economic risk. And there's also the risk of inflation. If the inflation rate is higher than the rate of return, that means you are losing money against inflation. So these are several types of risk. And also we have all the default risk, which is the credit risk of the issuer, the credit risk of the uh, investment instrument, like if it's a bond, the the default risk not paying the interest and paying the principal amount at maturity by the company. And there's a interest rate risk, which is the price risk. Interest rate goes up and down, and if interest rate goes up, the people will take money out from the stock market and put in the monetary market. So the stock price might fall with an interest rate rising. And the contrary is also true. If interest rate is lower, then the bonds carry a fixed interest rate, making more valuable to a lot of investors. So bond price may go up, go down. Liquidity risk is how soon you can sell the investment instrument. If you're holding a property, it may take you 2 or 3 months, even years, to sell your property. But if it's a commercial bond, you can sell it on the bond market. You can sell it on the security market, stock exchange, for example, for listed companies, or easier to sell. And this reinvestment risk, when you sell the investment vehicle, can you buy another vehicle which carries the same investment return? Or maybe sometimes if you higher, it's more difficult to buy. Sometimes it's cheaper, meaning that you will experience a have nothing to buy if you don't have the cash. So that's called the investment rate risk. So if you're achieving, let's say, a 10% investment rate return, but you cannot guarantee when you sell the investment vehicle, you will realize the same rate of return. So that is called the reinvestment risk. Okay, and there's also the exchange risk. If you're holding a US dollar position, you can sell it into European dollars, to Euro dollar, experience an exchange risk because there's a time that between your buy and sell period. So that is exchange risk. And it's a sovereignty risk. It means your country may be going to war, maybe into the like like Myanmar right now, they have a political riot there, and there's sovereignty risk there. And you're putting investment into the infrastructure project or the nuclear plant project in UK or in Myanmar, they're in trouble. Operations risk is something that uh, happens to your internal operations. Uh, Sometimes you may make mistakes. Sometimes you may record uh, cannot maintain your accounts. Sometimes there is legal risk um, imposed on the operating fund. The change of laws, for example, change of US laws that prohibits to buy or sell certain type of investment. There's an operation risk and legal risk, political risk too. And the type of risk of default and inflation, and there is a risk and return trade-off. So higher the risk, normally higher the return. So the highest, and this often happen in your exam paper, as the highest risk is the derivatives. The derivatives, like say the options and put options, warranties, and warrants is the highest derivative vehicle with the highest risk because it takes a leverage positions. And the second is the equity risk, and then is the bond risk, and then the short-term commercial paper risk, 3 months, half a year type of investment. Then it's most secure as opposed to be the bank deposits. And in Hong Kong, we have the deposit insurance, so this is protected up to $500,000 in Hong Kong dollars. And also, the supposed to be zero risk will be the government bonds, government treasury bills, for example. Your treasury bills are supposed to have no default. So risk return techniques. How can you reduce risk? And there are a few strategy. One's called diversification. Invest not just on one stock, but a variety of instruments. And that is the dollar cost of averaging, means you buy and sell at different times regularly. So when the market is going up, you buy less, but you're still buying. But when they go down, you buy more. Sometimes it's more, sometimes it's less. So the average out you have a more stable over a period of time. That's called the uh, dollar cost of averaging, long-term fixed regular payments investment. And at a time, as a risk moderator, you can buy and sell at the same time. Buy one stock, sell one stock at the same time, buy Hang Seng Index and buy and sell stocks, buy short selling, long selling, and then catch up with the index. So it's other risk hedging tools. So these are not the only ways. There are more ways, like a hedging fund. You buy, take a position, and also you offload the position at the same time. Take a time gap. You buy now, sell futures. Sell now, buy futures. These are hedging schemes to manage the risk, to contain the risk in certain percentage. Risk return, there is low when there's a low correlation. There was a low correlation of risk items, meaning that you have, for example, if you the stock market value maybe have no relation with the real estate property market, so it's not very highly correlated. But in terms of equity funds, the American funds may be highly correlated with the Hong Kong market bonds, market equity funds. So when U.S. market go down, Hong Kong market also goes down. That's called a highly correlated market. But there are sometimes low correlations between some sort of investment, and that's but by using a balanced portfolio that, like for example, the equity funds, the equity investment in the banking sector may have no correlation with the energy sector, oil prices, for example. By different investment tools and vehicle, you achieve a risk reduction strategy. And the pound cost, dollar cost averaging is to buy and sell a different period of time. Sometimes high, sometimes rising market, sometimes a bull market, sometimes a bear market. You keep buying, keep a certain amount of buying, irrespective of when is a good time to buy or not. Then, on average, you will achieve a long-term, more stable return for your fixed amount of investment into the market. That's called the dollar cost. And time is a risk moderation. Well, always if you can buy low and sell high, then you realize the profit, right? But if you sell high and buy low, you also make the same profit. So it doesn't matter whether it's a rising market, bull market, or bear market. You can always make money in either side. Because in a bull market, you can buy. You'll never lose in a bull market because future price is always higher than the present price in a bull market. But in a bear market, you can always sell, sell short, sell before you have the product. You have to have. You can sell in the morning and then buy back the same stock. You have to know it, and then you square your position and you make the daytime trading. So you still make profit. That's a lot of people doing day trades are doing. So risk management process, and I think this is often happens to take place in exam paper. There are four ways of managing risk. One is to what you have to identify this first. What type of risk we're talking about? We're talking about interest rate risk, inflation risk, country risk, legal risk. What type of risk are we talking about? And how can we measure it? In terms of investment, the risk is measured by the standard deviation of the prices of the instruments. If the standard deviation is high, it means the risk is high. The standard deviation is small, meaning up to, let's say, 10% of the time, 50% of the time, the prices between $2 to $3. That's the standard deviation. We're using that to measure the risk level of a particular investment instrument. Compare the different risk levels. The higher standard deviation is, the higher the risk is. And then with the manager, how do we manage it? We cannot manage the default risk of the investment, the type of company they invest, but we can manage the portfolio to have different types of instruments in the portfolio by using the hedging mechanism, by diversification mechanism, by using all types of risk management tools. And then we have to monitor the risk. So these are the four actions we have to take: identify, measure, manage, and monitor. So to identify the risk, we must know the companies, whether the company is good prospect or not, whether know the market, American market, US market, economic factors of the American market, and the political risk that your instrument is facing. And you measure it by the expected return, by the volatility, by the Sharpe ratio. I don't know what is a Sharpe ratio. Explain what is Sharpe ratio. You can do it a Google check, right? There's a Sharpe ratio. Some sort of measure.
Average return earned in the excess of risk-free rate per unit of volatility.
What is a Sharpe ratio?
Return of portfolio minus risk-free rate divided by standard deviation.
Yeah. Okay, there's a textbook. Rate of return compared to risk. Okay, so risk-free return, and then this is Sharpe ratio. Future return of portfolio minus the risk-free rate divided by the standard deviation is the Sharpe ratio. Okay, good. Thank you. Back. It's called the Sharpe ratio and other measurement of risk. Expected return. Expected return, for example, in terms of fund A as 0.3% of making a 20% return, 0.7% making 5%. So the expected value is the expected return times the chances we get a 9.5% expected return. On Fund B, you have 30% that is down by 10%, but 70% of chances that you achieve a higher return than 20%. So end up this Fund B is as an expected return 11%, which is higher than Fund B. So by the expected return adjusted by the probability of achievement. Right? So this is a comparison of expected return. But this is an arithmetic average. It doesn't make a lot of sense. Even though you have 11% here, but because your assessment of the probability may not be correct, and also expected returns may not be correct. So it's just a guessing. Even if you compare between these two, it looks like on average and everything according to its probability, then you have a higher chance of getting a bigger return for your investment from the fund B. And that's an expectation. That's not necessarily the truth, not necessarily the real, the reality. Although this one looks like that it's making a better return, but the less chance of making that return. This one is a higher expected return, but more probable making the return. So my merges here should be higher. So I would make investment based on this simple combination. Okay, volatility. Uh, and higher the volatility of the price. Sometimes it's $2, sometimes $4, sometimes $11. You can try to measure AIA's risk. It is keep rising. So there are lots of ways to calculate the risk, and this one is the Sharpe ratio. The Sharpe ratio is compare the expected return. Let's say the expected return of this fund B is 11%, and the risk-free interest rate is 3.5% because it's compared to a normal traditional savings policy. 3.5. This is risk-free, right?
How do you get 3.5?
Well, because AIA says guaranteed cash returns 3%. It's guaranteed by AIA, so this is risk-free interest rate 3.5%, and this is expected return 11%. And you divide it by the volatility rate by the standard deviation of the price, and you get the relative comparison of the risk return ratio. That's what it's supposed to measure. So in the paper, if you find out this Sharpe ratio, and you know that's comparing the two, and it's comparing the standard deviation of the stock prices of the investment prices. Managing the risk, and you have to have a risk management department which has a highly monitoring of the risk, and there is internal monitoring. So if the price, we called it the hit price and the quit price. If you hit this price and it's better, it reach my expected return and probably trigger a sell decision. If we lower than the certain price and it trigger a buy session, buy low, sell high. That is monitoring decisions. And you set the mark. If I have an investment, if it hit this price, I will sell. If it goes up to this price, I hit my expected return, I will sell. So whether it go up higher than again, I don't bother. I just want to make my 10% return. Good. So you set the buy and sell price. That's more risk monitoring. People like me don't monitor risk. So for my MPF funds, I just let them sit there, never bother to manage it. So when it was high, reach 20%, I didn't sell. Reach 20%, I didn't know. So when it reached 30% and it goes down back to 10%, then I thought my loss. I didn't capture the gain opportunity. That's the problem of not monitoring your investment. So how the risk management is done in Hong Kong? One, we have the monetary authority, which is called the IA Monetary Authority, which is a capital CAMO system, capital equity ratio, which is what it is. Capital asset ratio, asset quality, how good is the management, how good is the earning, how good is the liquidity of the company. Now this model to manage the risk of a financial institution, the niche of the fund. And Security Commission The Security and Future Commission monitor risk by monitoring the individual company's performance. They have policy research units. They also have a um, indemnity mechanism.
The right one is for insurance and the left one is for
Monetary authority is for banking, financial institutions. This for security and future monitors the listed stocks and listed vehicles in the investment stock or unit trusts because all the unit trusts are listed in the stock exchange. All right, risk management tools on day-to-day management. They have to calculate the market value and set prices, set limits for keeping the stock, day trade limits and overnight limit, and then there's stop loss limits. And they have to set a hedging offset mechanism. If offset, meaning that by holding stocks, I also selling a future financial future. So it's so if I'm holding my HSBC stocks at $42 and then if we keep going up, then I will make some gains from the stocks. If I also sell the Hang Seng Index at present price level, if the Hang Seng Index falls and and then I will make some money of the downfall and also compensate my loss in stock price. That's called hedging, using financial futures and the present holding of the stock, taking a financial positions and selling forward or selling short. You can buy Hang Seng Index up, down, and expecting Hang Seng Index will go up or go down. So once you reach the limit, you will, uh, if you so if you're holding some stocks and if the price goes up, you make some money. If the price goes down, you will lose some money. So you have a potential gain or some loss. What if I, at the same time, I buy some stocks and I also selling a future, selling a Hang Seng Index future? Say if the index, Hang Seng Index goes up to by 10 points, then I will make this money. But if you, on the contrary, if it fall by 10%, I will lose money on this part.
yes.
Right? So if you hold some position to sell something, if it fall down to this, you make some money here and compensate your loss in financial. You have to calculate the offset.
Right. But if you sell low, you lose money here, right? How can you compensate this?
Now, if you sell short, meaning that sell future, I expect the Hang Seng Index to go down,
Uh-huh.
then you will make money when it really goes down.
Ah,
When it goes down, your price goes down too. So you make money here, you compensate your loss here. If it's a 1-to-1 ratio, then this balance. And if you lock in a profit, so if it go down, I will take this part of the loss, I can absorb this loss, but it go down further, then I will compensate. So you can lock in a cushion by selling forward a buy or sell positions in the Hang Seng Index. That is called hedging. Same with currencies. If you're holding US dollar currency, spot decision, I will sell forward same amount, 1 million US. I will sell 1 million US at this price. Let's say you buy it in, let's say US dollar to yen, for example. I don't know the exchange rate X. And if it goes up to X plus one, I'll sell it. If it goes down to X minus Y,
sell.
No,
I will buy more.
I buy more. Yeah. So this is called hedging position. Buy and sell at the same time. If you're not, you're just taking buy or sell on one side and you're taking position. We call it open position. You can close this position by buying and selling at the same time. So you make one profit on one side and make um, balance on the other side. So you limit your risk. You know, you buy and sell at the same time. You limit the risk. This is what I can set. If it goes beyond this rate limit, I'll stop my gain and I'll stop my loss. There's always day trade people, banks, buy and sell US dollars and sell, buy and sell Hong Kong, buy in Hong Kong and sell in New York. There's arbitration. What arbitration?
Buy in Hong Kong, sell in New York.
New York.
In US dollar.
Same currency, same, yeah. And buy in Hong Kong Stock Exchange and sell the ADR in New York. Right, buy because there's a time difference. New York is always late, 12 hours. If I buy from Hong Kong, sell in say New York, 12 hours later, I take this position again and take profits. Can take profits. You know, if I know tomorrow there'll be good news announcing, so I buy AIA, some stocks that are trading both cities, then you can make this
So you buy.
arbitration.
So you buy first in AIA and then sell in New York because it's later.
12 hours later. As long as the stock is also listed in New York, about called the ADR, open counter. One stock, one stock listing option in New York is called ADR, open counter operation. So it's trading around the globe. So in gold trading, in currency trading, even in stocks, or even in warrants, they can do this. That's why in Hong Kong, there are a lot of financial institutions doing this. We call it treasury dealing. The Treasury Department does that. Because there's a rate, also interest rate. The interest rate in US dollars in New York may be, let's say, 0.5 right now. The 10 years, the 20-year Treasury bill is 1.5. While in Hong Kong, the interest rate is also 0.5. There's an interest rate gap. You know?
Is this in Hong Kong dollar?
No, US dollar. US dollar Hong Kong market. Interbank market. And then the Treasury bill 20 years Treasury bill to 1.5. There is an opportunity to gain from this interest rate. You know, when the Treasury bill went to 1.5 on one particular day, out of the expectation of the people, all the stock prices because a lot of money will go to buy this, to sell the stocks to go into this to make that 1.5%.
I don't think it will happen.
It happened in the past. So there's on one day that stock prices went down by more than 5% in all the global market because of this unexpected surge in interest rate. The 20 years long bond.
Sorry, I need to say.
Okay, we should stop. We should stop here. There is a very expensive. We call the financial crisis in 1995 as a barring trigger the world's financial crisis. It happened in Indonesia. You know, and they opened positions in Indonesian dollars, made a lot of investment in Indonesian dollars, but do not hedge it, do not manage the risk against US dollars. Base currency is US dollars, but they made a lot of Indonesian investment. When the Indonesian investment is down, when depreciate, when the Indonesian dollar depreciate, and borrowing, they own borrowings from US dollars also suffered the financial loss, major financial loss, and then the whole financial institution went bankrupt. And these companies are a company which raised a lot of bonds, company bonds, and managed a lot of funds. When they bankrupt, in the taxation, in fact, trigger a Asian financial crisis. And in 2007, 2008, the global financial crisis triggered by the American uh, paper, I mean the mortgage-backed securities, when it is overvalued, when a lot of defaults in the mortgage market, the mortgage-backed security does not cannot have a default risk, and then trigger the global financial crisis. So there's a default risk. Just don't imagine, even the largest bank, the largest company can also suffer mismanagement of the risk. I think this one is, I think this parallel also happened with a bank treasury department, which induced a lot of financial losses, lose the whole bank because it's mismanaged positions. If you read the history, I think it's one dealer in the treasury department which made some stupid deals and caused the banks a lot of financial losses, millions of dollars of financial losses, bigger financial crisis.
Just because of one person?
One person
Huh?
do not have monitoring on controlling the limits. This abuse his trading limits. You know, it also happened in Hong Kong recently when their oil prices went down. So a lot of the funds investment in all unit funds so low down, lose all the principal, even banks. Well, that's all for chapter one, investment, basic knowledge about risk management and also type of risk. We shall stop here for the time being. Continue next time. So
You want to stop sharing, right?
stop the recording first. Okay. Well, this will end this part of the risk and return discussion. If you have any question, raise it to your supervisor, and we'll stop here. Thank you. Say goodbye.